Today's situation is in many ways similar to the massive financial crisis in 2008, and if you remember, in early 2008, most headlines were forecasting growth of the S&P 500 in the US economy. This is the forecast for S&P 500 top economists gave. And this was Warren Buffett's forecast for the stock market. He was right. A massive financial crisis hit, and the stock market plunged. The Buffett Indicator was ignored by most people at the time. We're kind of used to Buffett being a legend now, but back then, only a few listened to his approach. The US economy is under serious pressure. Trade tensions, wars in the Middle East and Ukraine, and a mountain of public debt. According to the Treasury spread model, the probability of a recession is now around 25%. You might already know that the yield curve spread is a highly reliable predictor of upcoming recession. The yield curve spread, specifically the difference between the 10-year US Treasury yield and the 3-month Treasury bill, is in fact one of the most trusted recession indicators in economic history. When the curve is inverted, it means short-term rates, like the 3-month Treasury, are higher than long-term ones, like the 10-year. That's not normal. In a healthy economy, longer-term debt pays more to compensate for time and uncertainty. See, whenever the curve flipped, recession typically followed within 6 to 16 months. Look at this chart comparing the CEI index and the yield curve. CEI tracks the present state of the economy. If it's rising, the economy is likely expanding. If it's falling, the economy may be contracting. You can see the CEI is always delayed by like 6 to 16 months behind the yield curve. So is the yield curve a perfect indicator? Well, just recently in 2023, something unusual happened. The yield curve inverted sharply and remained inverted for an extended period, yet no recession followed for the first time. However, if we look closely, it depends on how we interpret the logic. We said recession usually begins during the 16-month window. Does it mean 16 months from the start it goes inverted? Or does it mean after it ends being inverted? Because it ended being inverted in October 2024. And that means that from that point, a typical 16-month window would extend to February 2026. That means a potential recession could still fit within the historical pattern. Recession in essence is defined as GDP dropping for 2 consecutive quarters. Well, right now we have the results for the first quarter of 2025. And as you can see, the US economy did drop by 0.5%. If there was to drop GDP in the second quarter of 2025 as well, we'd be talking about recession. Since the GDP is calculated as sum of consumption, investments, government spending, and net exports, recession happens when people are spending less. C goes down. Businesses stop investing, I drops, and exports may slow. When this happens for 2 quarters or more, the economy is officially in recession. Factories produce less, companies may lay people off, and markets tend to fall. Looking at the current stock market, S&P 500 hit its all-time high recently. That does not seem very recession-like. The stock market is booming. However, keep in mind that business cycles do not equal the stock market behavior. The relationship between these two is sometimes not very direct. The US stock market given by the S&P 500 has a big analytical issue, and it is this. Stock market can be overvalued or undervalued, meaning the price of the stock does not correspond to its true value. That is a dangerous situation. Valuation, for all its formulas and models, is often more art than science, and sometimes flat out wrong. Markets are supposed to be rational, pricing in all available information. That's the core idea behind the efficient market hypothesis, EMH, which essentially says that bubbles do not exist. We know, in fact, bubbles do exist. In reality, stocks are sometimes very irrationally valued, and the efficient market hypothesis is super wrong. The dot-com crash, the housing bubble, the 2021 tech melt, all happened in plain sight, while EMH purists claim markets were fairly priced. The truth is, prices don't always reflect reality, but rather delusion. So Warren Buffett back then was so smart, he came up with this indicator that always alarms us authentically, that the stock market is overvalued. It's a ratio of total US stock market value and gross domestic product. This ratio fluctuates over time since the value of the stock market can be very volatile, but GDP tends to grow much more predictably. The current ratio of 200% is approximately 57.05%, or about 1.8 standard deviations, above the historical trend line, suggesting that the stock market is highly overvalued relative to GDP. And here comes the essential revelation. The 2008 financial crisis, just like the overvalued stock market, could be uncovered by the Buffett Indicator. Economists sometimes use these charts comparing production utility capacity or sales of new homes. It is useless, as you see. These 2 factors can't forecast anything. This gives us time ahead to assess whether the stock market is overvalued or undervalued. So if we're discussing crisis in 2001 and 2008, 2020, which also were financial recessions, you can see the curve behaving like this. Looking at the historical behavior of the Buffett Indicator, we see a clear pattern. When the ratio rises sharply above long-term averages, trouble tends to follow. In the late 1990s, the indicator surged before the dot-com bubble burst in 2000. It peaked again just before the 2008 financial crisis, as markets became disconnected from real economic output. More recently, it reached extreme levels during the COVID-era stimulus boom, and once again today, it's hovering near historic highs. In each case, markets were overvalued, optimism ran ahead of fundamentals, and major corrections followed. It's honestly shocking how few people are paying attention to this. People are listening to Buffett, but not to his best ideas. Thank you for watching. You're here to feel good and feel well. This is Glennius.